I'm going to be honest with you. I really don't have any special or beautiful charts to show you right now. But what we will talk about in this video is incredibly important. Michael Burry might be right, after all, about this whole Nvidia bubble thing. I mean, we may have just seen one of the ugliest candlesticks in candlestick history. Look at this thing. We're talking about a swing of just about 8% on one day of trading of a company that's worth about 4.5 trillion. So almost $300 billion of market cap shed from the open to the close. And you'd think with earnings beating on basically all cylinders. Revenue, massive jump. They're selling a lot of chips. Gross margin, jumping because Blackwell and Rubin Ultra are going to be even more profitable than the prior iteration of chips. Operating income jumps, net income jumps, EPS jumps. Pretty much everything jumps about 60 to 70%. So what gives? What's going on here? What does Michael Burry have to say to this? We all know he's been short Nvidia for some time now. He's been short Palantir, which if we look at that chart, it's actually even uglier than Nvidia's right now. So what gives? What do we have to look at? Again, I don't have many fancy charts to show you, but what we will talk about is so incredibly important, and it's just the facts of what's going on right now. So to get started here, we're not going to waste any more time. There's really three arguments that the bears have when it comes to Nvidia. We all know the technology is a beautiful thing. You can't go wrong. AI spend is continuing to grow at an unprecedented rate. In fact, OpenAI and Anthropic are two of the fastest growing companies that the world has ever seen. So what do the bears have to say? Well, there's three, and one is the first, highlighted by none other than our good old friend Michael Burry. Depreciation. And it's good to preface, anything that we read from Michael Burry is usually pretty hard to understand, at least at first glimpse. And so let's break this down piece by piece. The idea of a useful life. In other words, how long is, say, the A100, the H100, some of Nvidia's old GPUs, how long are those things actually good for? Because if they're able to sell them at, let's say, $10,000 to $20,000 right now, but then they're worthless in, 1 or 2 years, then these bigger companies like your Microsoft, like your Oracle, like your CoreWeave, Google, Amazon, all these companies buying chips hand over fist, they might be a little concerned if the useful life is, 1 or 2 years. And it's almost like Jensen Huang was listening and he was reading this tweet from Michael Burry. You know what? The useful life for chips isn't 1 to 2, 3 to 4 years. It's 6 years. In fact, Nvidia's still running A100 chips at full capacity. Chips that are now 6 years old and about 3 generations from their newest platform in Blackwell and 4 generations from Rubin Ultra. And you know what? You could deep dive into the financial stuff if you really like, but at the end of the day, let's just simplify this and make it nice and easy. Because again, do we really care that much about all the nerdy financial metrics here? No. And so what we're going to do is simplify this chart. Michael Burry presents the depreciation useful life. How long are these chips projected to be useful for? And we can see some of the biggest companies in the world, some of the companies we just talked about that are buying the absolute out of all these chips. Amazon 5, Microsoft, Oracle, Google 6, Meta 5.5. And the takeaway is, can chips really be useful for that long? If Nvidia chips and servers are on a 2 to 3 year product cycle, in other words, we just had, say, your H100, H200, and now all of a sudden Blackwell is coming out about 2 to 3 years later, is that 6 year time horizon actually right? And this is really important for these companies because it's like an accounting magic trick. You don't have to put all this debt that you just committed to buying chips on your balance sheet all at once. You can depreciate that loan, depreciate that money over, say, 6 years. That way investors won't be spooked and absolutely run for the hills when Oracle says they have a debt to equity ratio of something that is straight out of a movie. You don't really want to see this if you're investing in a company. That means if shit hits the fan, then things are going to go sour really, really fast. They have a lot of debt on their balance sheet. They have to pay a lot of bills, and the revenue that they're getting from, this big cloud compute AI infrastructure build out just isn't there to support this incredible amount of debt. So companies can depreciate these assets over said times, over 5 to 6 years, and all of a sudden that debt looks a little less scary than it does right now, obviously. In this video is designed to really come at the AI infrastructure build out narrative and super cycle, as they say, from a bearish perspective. And they say the best way to learn and, not get completely blindsided when you're all out bullish all the time is to look at the bears. What are they thinking? And Michael Burry is certainly that. He thinks that these companies are going to understate depreciation by $176 billion. In other words, they're going to make their earnings, they're going to make their money look really good when actually their money is not looking good. They have a lot more money to pay, artificially boosting earnings. Now, the flip side to that is there's such a ridiculous amount of demand for no matter what chip it is, like we just saw with Nvidia. They're still renting out their A100 chips at full utilization. So people are actually willing to pay more for these old chips and potentially overstate their debt. So the opposite could also be true. But again, we're trying to look from the bear perspective here, and he does have a point. 2, share buybacks. And when you hear share buybacks, you might think, well, that's good. A company is buying back the shares that they originally issued on the market. And so that means they're effectively reducing the total share count that's on the market. And when you reduce share count, there's less supply, and hence that share price should go up, right? Less supply, demand stays the same, price goes up. And again, what better way to give this analysis, to simplify all this, then go to Michael Burry, look at his cryptic financial analysis about share buybacks, about earnings over time. And I thought Red Ketchup really summarized this best. This is pretty much what I've been saying. You want to decode it into human speech. Yes, Burry language into human speech. Here we go. Again, it's kind of an accounting thing, but this time it's specifically with Nvidia, not the companies that are actually buying from Nvidia, not your big tech, not your Oracle. It's Nvidia itself. Since 2018, Nvidia's made a lot of money. They gave out a lot of money to their employees, which makes sense. Reward the employees who got you to where you are today. I mean, look at this. This is absolutely absurd. Nearly 80% of Nvidia employees are millionaires. 50% of Nvidia employees are now worth over $25 million. So yes, obviously, these employees are getting compensated really well. They can actually buy stock at a discount, which does in essence kind of dilute the shares that you and I are buying because they're getting it at a, 10 to 12% discount, whatever that discount is. Here's the bearish argument. Nvidia bought back $112.5 billion worth of its own shares. And like we just talked about, if you reduce the number of shares in circulation, then you're actually inflating the price of that share, right? There's less of them, the demand stays the same, the price goes up. But what's weird is after buying all these shares, this $112.5 billion worth, there's actually 47 million more shares today than there were back in 2018. And simply put, employees are getting that sweet stock-based compensation. 50% of the damn Nvidia population is worth over $25 million. So clearly that's taking a hit. That's diluting the shares that you and I have of Nvidia, and their buybacks just aren't able to undo this cycle. And this is where the jump from Burry is kind of made, and it's debatable if that is actually valid. The argument is the money that Nvidia invested into buying its own stock back didn't offset the amount of dilution caused by this stock-based compensation by all these Nvidia millionaires. And so that's effectively cutting the value of the company's earnings to owners by half. And what's the flip side to this? Nvidia's going to the moon. It can't go down. We do so well. We make all the chips. Everybody buys our chips as long as the stock keeps going up. And when the stock keeps going up, you know it. Your mom knows it. Your grandmother probably wants to buy Nvidia when she sees it's up basically every single day that the stock market's open. And Nvidia can use this money from their shareholders to invest in building out new chips, researching and developing new platforms like Blackwell, like Rubin Ultra, and ultimately just spend the money on CapEx investment. And that way they can sell more chips to more companies. Hence why they've been growing like a tiny software company as the biggest company in the world. And finally, I think the most damning out of these reasons, last but certainly not least, I think the most important factor and one of the biggest reasons we saw an all-out stock market sell-off, unemployment rate did come in pretty hot, but we're not talking about unemployment right now. We're talking about Nvidia because they basically run the entire stock market, is this idea of Jensen lying? Huh? Is Jensen lying about how many chips that Nvidia's able to sell? He said they're completely booked out. They don't have a damn chip to sell. They need to manufacture more. Every company in the world needs more chips. They need more AI infrastructure. Big tech is spending out of their nose while OpenAI loses a ton of money. We gotta build out massive data centers, okay? They have $500 billion in revenue visibility into the coming quarters. In other words, there's a lot of commitment from these big tech companies. The amount of capex that big tech is going to spend this upcoming year in 2026 is much greater than in 2025, so things are looking promising. Nvidia jumps massively on the news. Nvidia beats across the board. Jensen Huang is a master at selling his product. He's convinced everybody that it's the only system you can buy, and boom, Nvidia almost tests $200 per share, jumps up about 7 to 8%, and then wham, what were people seeing? The 10Q always has the information that we need. Let's take a look at this. So, Jensen Huang told us that they are sold out. If they're sold out, we probably shouldn't expect to see finished goods growing. Pretty much a double from about 6 months ago. Now, raw materials, I feel like is more justifiable, right? You need all the Micron memory, you need all the Fabrinet optic cabling, you need a whole lot of stuff to go right to put together one of the most advanced chips ever made, ever sold on the market. So building up your raw material supply, that makes sense. Your work in process is now, what, $8.7 billion? I mean, I guess that might be justifiable too. At the end of the day, there's a lot of chips to get out there. You're working on making Blackwell. You're going to be working on Rubin Ultra in the second half of 2026. There's a lot to do. We all know TSM is absolutely capped out. Nvidia basically owns 75 to 80% of their manufacturing line. But then you have $6.8 billion of finished goods in inventory. What's going on? What's going on here? We just heard that you're all sold out, but you have $6.8 billion of finished goods of your H100, H200s, maybe Blackwells, just sitting there. What are they doing there? So this is where people might be skeptical. Is Jensen lying about the demand? Sure, they can have visibility into $500 billion worth of spending. And in that case, these finished goods should probably be coming off the shelf sooner rather than later. But it is definitely a little strange to hear Jensen Huang talk about how they're completely booked out. There is incredible demand. There is not enough supply of chips. The demand outpaces supply by what, 12 to 1 or something absurd like that. And hence they can charge a ridiculous amount for chips and they get their 70 to 75% margins, which are absolutely insane for a company that's pulling in $60 billion of revenue per quarter at this rate. I mean, my question to you is, what could have possibly drove Nvidia down today other than three of the things we just talked about right here? And I apologize, there weren't any pretty graphics to go along with this, but I thought this information is so valuable to look at because it's so convoluted and hidden in the weeds. Like, who's actually reading through 10Qs, right? When you see a post that starts with anything like how Michael Burry writes his tweets, it's like, dude, I'm not gonna read that. Come on, man. I'm just gonna go into the comments. I'm gonna say, hey, dude, that sounds bad. Or, hey, man, not gonna read this, but Nvidia to the moon, and move on with my life. Like, there's no way I'm gonna read this. So taking the time to go through all these things, including the 10Q on page 15, all right? 15 in the fine print. What is going on here? Why is there such an inventory buildup? Is Jensen actually lying to us? I mean, you know my perspective at this point. I've came out with a lot of videos going through Nvidia's technology, their advantage in the sector. Their moat is just getting larger at this point. Their partnerships are absolutely absurd. They're literally giving money to the companies buying from them and then getting 3 to 4 to 5 times the amount of money they invested. Jensen just told us it's going to take, $50 billion to build a 1 gigawatt data center, and OpenAI is going to have to buy about $35 billion of components of systems of architecture from Nvidia. So Nvidia's like, you know what? We can solve that problem. We'll just give you $10 billion. So that way you can build out this 1 gigawatt. Then we'll print $35 billion of revenue. It's that simple. Again, what Jensen is telling us is probably more truth than false. As the CEO of the company that's selling all the chips to these data center companies, to these big tech corporations, he's talking to executives every single day, understanding the demand that's not only on the enterprise side, your big tech companies, but also on the consumer side. You and I buying OpenAI's ChatGPT premium subscription, Claude, which I personally think is actually better right now. I mean, we can see CapEx is only growing, right? 76 billion 2024, it's going to be 376 billion over the next couple of years. I think that number just got even higher. Jensen Huang just announced during the earnings call. So a company absolutely smashing all across the board. If you have your foot in all those different doors, then it makes for a pretty convincing and appealing future. And again, we're not here to talk about all the great Nvidia technology and stuff that they're doing, because that wasn't the point of this video. The point was to understand where the super bears are coming from, where Michael Burry, Cassandra, the one cursed with prophecy, but also no one ever believed her. Cursed with the knowledge, but also cursed with the disbelief from others. So I hope this helped and was somewhat insightful and interesting. If it was, subscribe, like, and comment, and let me know. If not, dislike the video. Thanks. See you in the next one. Bye-bye now. Bye.